Okay, let's dive in. Welcome, everyone, to the deep dive. Today, we're tackling a question that, well, it gets a lot of airtime, sparks curiosity, and maybe, let's be honest, a bit of frustration, too. How do wealthy individuals legally minimize what they owe in taxes?
Yeah, it's definitely a hot topic. And it often feels kind of murky, doesn't it? Leading people to think there must be some, secret handshake or maybe even outright cheating going on. But what our look into the material shows is it's often less about breaking rules and more about really understanding them, using the system as it's actually set up.
Exactly. So for this deep dive, we're drawing on insights from an episode of a show called Wealth Unfiltered. They had a tax strategist, a wealth advisor on. Our goal here is basically to pull out the key ideas from that chat, lay them out for you, and give you a kind of shortcut to understanding how this all works legally, and maybe touch on why the system seems designed to reward certain financial moves.
Right, because that core question really gets to it. How is it possible someone with, significant wealth might pay a lower percentage in tax than someone earning a good middle-class wage? And the material really suggests the answer isn't about dodging the tax man, but about mastering the rule book.
Okay, so let's get straight into that. There's a fundamental difference highlighted in the material about how the tax system even looks at income. What's that key distinction?
Well, what's really interesting, and kind of the foundation here, is that the tax code seems to reward specific actions or behaviors, things like investing, owning businesses, maybe creating jobs. It rewards those things more tax-wise than just earning a regular paycheck.
Ah, okay. So your salary, the money from your job, is kind of taxed the hardest right from the get-go.
That's generally true, yeah. Earned income, that W-2 salary you get, usually faces the highest tax rates, ordinary income rates. But income that comes from assets, that often gets treated differently. Lower rates, or crucially, more ways to offset it with deductions and planning.
Which brings up a really key point from the material. It's not necessarily about not working or earning money that way. It's more about how you structure your earnings and learning to think, well, more like an investor thinks.
Precisely, yeah. And that structure really starts with knowing the different buckets the tax code puts income into.
The source material broke it down into three main types. Can you walk us through those?
Sure. So first, there's earned income. We just talked about that. Your salary, wages, bonuses, basically money you get paid for doing work. And like we said, generally hit with the highest tax rates. Ordinary income. Second category they mentioned is passive income. Think rental income from property. That's a classic example. What's interesting here is it often has, well, potentially lower rates, but also usually way more deductions you could take against it. And then the third type is capital gains. This is the profit you make when you sell something, an asset, for more than you paid for it. Stocks, property, that kind of thing.
And this is where it gets really, really interesting tax-wise, because how long you owned that thing makes a massive difference, doesn't it?
Oh, absolutely critical. Yeah. The material really hammered this point. The difference between short-term and long-term capital gains is huge. Sell something you've owned for less than a year. That profit usually gets taxed just like your salary at those higher ordinary income rates. But if you hold on to it for more than a year, that profit becomes a long-term capital gain. And the tax rate on that is significantly lower. I mean, we could be talking 15%, maybe even 0%, depending on your overall income, compared to, 30% or more you might pay on your salary.
Wow. That example they used really drives it home. Someone earning, say, $100,000 from a job might pay, what, $25,000, $30,000, maybe more in federal income tax, easily. But someone else makes the exact same $100,000 profit selling stocks they held for over a year. They might only owe $15,000, or like you said, maybe nothing at all.
It's a completely different calculation. Same amount of money coming in, but the source radically changes the tax bite.
It really does. And understanding that difference is, well, it's fundamental to getting these strategies the wealthy use.
Absolutely. So let's look at one of the big ones they talked about, real estate.
Yeah, real estate always comes up. What makes it such a go-to tool for tax planning?
A huge piece of it is this concept called depreciation. It's a bit counterintuitive, maybe. The tax rules basically let owners of rental properties, for example, deduct a portion of the building's value each year. It's supposed to represent wear and tear.
Okay, but wait, doesn't property usually go up in value? Appreciate.
Often, yes. And that's the kind of magic tax trick here. You're legally allowed to take this depreciation deduction every year. It's like a loss on paper. Even if your property is actually increasing in market value and you're collecting rent checks every month.
Whoa. So you could literally be pocketing cash flow, making money from the rent. But on your tax return, because of depreciation, it looks like you made zero profit or even lost money on that property for tax purposes.
Exactly that. Cash in your bank account, but the depreciation deduction wipes out some or all of that rental income on your tax form. Sometimes it even creates a net paper loss that can shelter other income too. It's that powerful idea, paper losses versus real cash flow.
Okay, that's a really clear example of how the system incentivizes earning assets like that. What about owning a business? That seems to be another major area for tax advantages.
Oh, absolutely. Owning a business unlocks a whole different set of rules. Basically, the tax code says, okay, you need to spend money to make money in your business. So it lets you deduct legitimate business expenses from your business income before you figure out what tax you owe.
Right, so rather than using money that's already been taxed, like an employee has to,
Right?
business owners can use pre-tax dollars for business costs.
That's the core difference. Think about it. If you're an employee and you buy, say, a book for your job or pay for your home internet you partly use for work, you use after-tax money. If you're in a 30% bracket, that $100 item really cost you about $140 of your earnings. But a business owner, if that same $100 is a legit business expense, maybe that book or a portion of the internet bill, home office space, even business travel or meals, they can often deduct that $100 directly from business income. They pay with pre-tax dollars. So that $100 expense only costs the business $100. Big difference.
Yeah, that contrast really highlights the advantage. And the source material got into even more, let's say, advanced strategies, particularly for people with significant wealth.
Hmm.
This idea of the rich don't sell, they borrow. What's that about?
Yes, that's a really powerful strategy, especially for those holding assets that have gone way up in value, stocks, real estate, whatever. The reason is pretty simple. Avoid paying capital gains tax.
Because selling triggers the tax, right? So if you have, say, millions in stock that's appreciated, selling means a big tax bill.
Exactly. So instead of selling that asset to get cash, they take out a loan using the asset itself as collateral. They get the money they need for living expenses or maybe to make new investments, whatever. But because it's a loan, it's not treated as taxable income.
And I imagine if you have millions in collateral, you can probably get pretty good loan terms, low interest rates.
Typically, yes, extremely favorable terms, often. Ultra-wealthy folks can get lines of credit secured by their portfolios at very low interest rates, so they can access liquidity, fund their lifestyle, without ever having to sell those underlying assets and trigger the tax on all that appreciation.
And this feeds into that strategy sometimes called buy, borrow, die.
Uh-huh. That's kind of the ultimate play for some. You buy and accumulate assets that grow in value. You borrow against them when you need cash, avoiding the sale and the tax. And then you die. And you pass those assets on to your heirs.
Okay, but what about all that built-up capital gain? The difference between what was originally paid and what it's worth now, does that just disappear?
In many places, yes, effectively. This is where the step-up in basis rule often comes in. At the time of death, the cost basis of those inherited assets gets stepped up to whatever their fair market value is on that date. So all the appreciation that happened during the original owner's lifetime, poof, it's essentially wiped clean for tax purposes. If the heirs then sell the asset relatively quickly, their capital gain is only calculated based on any increase in value since they inherited it, which might be very little or none at all.
Wow, that is quite a mechanism for passing wealth without that tax hit. It really underscores a different way of thinking about taxes altogether.
It really does. And that mindset shift was another key point in the material. You know, for a lot of people earning salaries, tax is just this thing that gets taken out. It feels mandatory, unavoidable. But for wealthier individuals, and especially those with advisors, tax is viewed more like a variable cost, something you can actively manage and minimize through smart legal planning.
It's treated less like a bill and more like a strategic puzzle, maybe, like that game of chess analogy they used.
Exactly like that. It requires understanding the rules really well, often hiring experts, sharp CPAs, tax attorneys, advisors who specialize in this. And it requires thinking long-term. It's not about finding loopholes to cheat. It's about structuring things optimally within the existing legal framework.
And this strategic view ties back to something you mentioned earlier, the idea that the tax code itself isn't just about collecting money, it's an incentive manual.
Yeah, that's a great way to put it. A key insight was seeing the tax code not just as rules, but as a set of signals from the government. It's designed to encourage certain things, investing, starting businesses, creating jobs, holding assets long-term, certain types of property ownership. So people who align their financial lives with those incentivized activities tend to naturally end up with lower tax bills. It's kind of the system working as intended. in a way.
Understanding that context is really helpful. It helps clear up some common myths or misconceptions people have about this. What were the main ones the material addressed?
Well, the biggest one is probably myth number one. The rich are all cheating. As we've been saying, the reality, based on the source, is that most are operating legally. They've just put in the effort, or hired people who have, to understand and use the available rules, deductions, income types, structures much more effectively. It's legal tax avoidance, not illegal evasion.
That distinction is critical.
Absolutely.
Mm.
Then there's myth number two. Only super rich people can do any of this. That's also not quite right. Maybe not the buy, borrow, die on a massive scale, but maybe the basic principles. They're accessible. Things like contributing to tax-advantaged retirement accounts like a 401k or IRA,
Mm.
starting a small side business to get business deductions, even just understanding long-term versus short-term capital gains for regular investments. These are available to lots of people.
So the tools exist maybe on a smaller scale.
Exactly. And myth number three, which we touched on, confusing tax avoidance with tax evasion. Let's be super clear. Evasion is illegal. Hiding income, lying on your return, that's fraud. Avoidance, which is everything we've discussed today, is using the legal structures, deductions, credits, and planning strategies allowed by the tax code itself to reduce your tax liability. Totally legal. Our focus is purely on the legal avoidance part.
Got it. That clarity is super important. So, boiling all this down, what are some practical, actionable things someone listening could actually do based on the material to become more tax savvy?
Okay, yeah, there were definitely some concrete takeaways. First one, track everything, your income, your expenses, get meticulous. You can't play the game effectively if you don't even know the score or where the pieces are. Use software, a spreadsheet, whatever works, but track it.
Makes sense. Know your numbers.
Second, think about a side hustle or small business, even if it's small. This can open up a whole category of potential deductions for legitimate business expenses, stuff you might be paying for anyway with after-tax money.
Right, turning personal expenses into potential business write-offs legally.
Legally, yes. Third, invest early and consistently. And really pay attention to those tax-advantaged accounts, your IRA, 401k, or whatever equivalents you have access to. Max them out if possible, and understand that difference between short-term and long-term gains. Holding investments longer can significantly cut your tax bill when you eventually sell.
Okay, track. Consider a business. Invest smart. What else?
Fourth, don't view hiring a good CPA or tax advisor as just an expense. Think of it as an investment. A qualified pro can spot opportunities and strategies you'd likely miss, and the tax savings could easily outweigh their fee. They know the rulebook.
Good point. Paying for expertise can pay off.
And finally, number five, educate yourself. The basic tax rules aren't secret, they're public. Read reputable sources, follow knowledgeable tax experts online. Just taking some ownership of understanding the system is really the first crucial step to navigating it better.
That sounds like a really solid set of steps anyone could start thinking about, no matter where they are financially right now.
I think so too. The core message really boils down to the system rewards certain financial behaviors. If you want to benefit from those rewards, you need to understand what they are and structure your activities accordingly. Legally, of course.
Right. And maybe that leaves us with a final thought to chew on. Instead of just getting caught up in debates about how much tax people should pay, maybe we should also think more about how the tax code is deliberately set up to encourage certain things like investment, like risk-taking, like building assets over the long haul. And then ask, how can more people, not just the already wealthy, learn to understand that system and use it legally to their own benefit?
Yeah, it really brings up the importance of financial literacy for everyone, doesn't it? Empowering people with that knowledge.
It certainly does. Well, hopefully, this deep dive has shed some light on a complex topic and maybe given you some things to think about or research further for your own situation. Thanks so much for tuning in.